as you recall, but picked up in the second half, ending the year on a high with renewed optimism after announcement of the full reopening of the economy. As you know, this is one of the greatest and most upbeat factors immediately post a 2-year slow period of lockdown. That reopening, bringing everybody back into the fora of activity is, for sentiments, is one of the most positive things. Inflation as well as lending rates began to rise during the year, despite the continued low CBR central bank rate, and the outlook from an inflation perspective is still that it will continue to rise in the short to medium term, given the global geopolitical issues as you know them, which will be feeding into the supply chains and energy prices and food prices, especially for wheat and oil. Those are things we expect to come into play. From a private sector credit point of view, in that next slide, credit to the private sector grew at its lowest pace since tracking of these indicators began in 2006. So as you can see on that graph, you can see the growth in private sector credit at 6.1% there, being significantly low. The only time we had credit growing at a rate as low as we witnessed in 2021 was only around the period of the election of 2016, which highlights really the cautious approach that has generally been prevailing in the market because of the heightened credit risk as a result of the pandemic and its impact on businesses. If you move to the next slide, move please to the next one. Yes, we talk a bit about sustainability and the sustainability agenda of the bank. So in order to drive sustainability and social impact, we revamped our environmental and social governance framework to guide the company's efforts in sustainably going forward. ESG is essentially environmental social governance, which incorporates these 3 elements in the decision-making process across the company. So it looks at energy, waste and circulatory of products, which speaks to recycling for the environment, customer and community relations for the social side, then accountability, ethics and diversity is encapsulated in everything that we do, just to try and see we're environmentally and socially well governed and responsible in that way. That slide 13 talks a bit about some of the key stakeholder engagements that we've been involved in during the course of the year. You will see that we continue to drive conversations around agriculture, promoting best farming practices with support of our partners, the Dutch Embassy. We also engaged in the oil and gas sector to drive local content participation, getting small businesses to try and find a niche to participate and to understand their opportunity that lies in there. But also we supported women in business to grow their businesses with financial literacy programs, etc. In addition to a wide array of SME additional support programs, some of which we also did with our partners. A good example that you see in there is the top 100 medium-sized companies survey, which we do with the Nation Media Group that we did last year as well. On the next slide there, we talk a little bit about impact in the community. DFCU is particularly local and focused very much on community impact. So from a social impact standpoint, we supported the medical sector, particularly in the Cancer Institute, with the patient waiting shed and children's play area among some of the programs we did, in addition to carrying out a vaccination drive for staff and third parties against COVID-19. We also supported the Kampala Capital City Authority and the Smart City Initiative by donating safety gear, and also supported the Happy Children's Home by donating essential items. Finally, we drove awareness of HIV as we supported the Kavaka Run that also promotes health and overall awareness of fitness amongst community members. In the pandemic, we saw the importance of being fit. And how it can support your body to work through a challenging time of a health crisis. If we move to the next slide, We'll now delve into the financial performance highlights for the bank, and I want to just spend a little bit of time on this slide. In this slide, you can see, we saw an increase in the operating income of the bank, driven by a 17% increase in net interest income and a 35% increase in non-interest income. These are key parameters for the bank. So that 21% increase in operating income demonstrated a significant improvement in our capacity to generate revenue. But we also saw a 26% reduction in interest expense. Now, interest is one of our biggest expenses that we've been working gradually to bring down, and I will share that as we go further down. But also an improvement in the cost-to-income ratio by 13%, coming from 63% down to just under 50%. That really demonstrates much improved efficiency in the operation of the bank. But because also growth of credit was, we were cautious on it and went slow in the year. At the same time, we cut back in our borrowed funds, repaid on some of the ones we were holding, and cautiously did not draw additionally, leading to that 16% reduction in borrowed funds. If we go to the next slide, okay, again, I'll spend a little bit of time on it because it has a bulk of numbers. So just to give you a rundown on the drivers that enabled us to deliver the results and the key issues that have impacted our earnings for the year. So starting from the top line, we delivered a 3% increase in interest income, which was driven by the strategic direction to grow our retail business while maintaining a leadership position in our other business segments such as corporate banking and global financial markets. So you will see there that our fee income increased by 23%, adding 11.7 billion to the numbers. And key to note is the significant emphasis that was placed on growing our trade finance business, which increased by 39%, in addition to the emphasis on benefits realization out of the digital solutions that we deployed that drove up our transaction levels across all digital channels to account for just over 76% of all transactions done by our customers during 2021. So that's a significant milestone, a major shift of transactions from legacy channels more onto digital. And just you see almost 3/4 of the bank's transactions now being done on those digital channels. Interest expense also is one of the great achievements made during the year, with a 26% reduction as we continue to drive, prices down on deposits through negotiating and dropping the expensive fixed deposits, but also focusing on growing the retail deposits in current and savings accounts. That's a much more sustainable way to grow. We also undertook a sustained effort in the area of cost management as we continue to drive down costs year on year with a 4.2% decrease in overall costs. Again, that is something we're very deliberate about. But the major area that affected the company was impairment of loans and advances to customers, which highlights the impact of the pandemic on the restrictions of customers' businesses and livelihoods. I just want to pause for a moment and give you a little bit of a history of DFCU and how it connects to local businesses. Right from our history as Development Finance Company of Uganda, we focused on supporting local businesses that we are ready to scale and to grow. And as a result, we have quite a number of significant large local businesses, the type of businesses that get impacted in a period like that which we had in the pandemic. And hence, the provisioning for a number of those loans, where we saw a sense of distress in those loans really prudently. So the 385% increase in loan provisions resulted in a reduction in our profit position, 39% when you compare a year on year. So that was the major impact on the profitability of the company for the year. On the next slide, if you look at this graph, it sort of tries to shed a bit more light on what I explained earlier about the trend of interest expense. So you can see during 2020, we spent 110 billion on interest expense. We brought that down for 2021 to 81.5 billion. So you can see that that trend, that's the lowest in terms of interest expense that the bank has been at. And we will continue that trend down to build a lot much more sustainability in how we manage our liability side of the business. If you go to the next slide. So that slide looks at our, the operating costs and that reduction in operating expenses that I spoke to a bit earlier. If you look at the trend between 2018 and 2021, you can see that we've been very deliberate in bringing down our operating expenses. If we compare the 2021 to 2020, you can see that movement from 191.6 billion to 183 billion, and then you can see on the right the cost-to-income ratio of the company and how it's trended down over the period, coming from 63% the previous year to 50%, which you see there. Like I say, just under 50. That is a significant movement, also kind of explaining the improved efficiency in the way the bank is run, and sets a good foundation for the future. If we go to the next slide, we have the statement of financial position. So on the balance sheet side, we deployed risk management in reducing our trading positions by 89% to avoid losses in the financial markets, while increasing the portfolio held to maturity investments by 6.8% as part of identified risk best practices in risk management. Now, our net loans and advances to customers reduced by 15%, as you can see there in the third red bullet, which we saw earlier, as a result of slow credit growth, very well calculated. It should be noted that while the value of loans reduced, the number of borrowers that we serve grew significantly by 40% during the period, which demonstrates our commitment to growth and the tilt towards retail, and also supporting smaller businesses and individuals to thrive and grow. Customer deposits also reduced by 12% there, if you can see, 313 billion. However, this was as a result of the deliberate strategy to reposition our deposit mix by shedding or repricing expensive fixed deposits during the period, and focusing on growing our current and savings accounts balances, as I've mentioned. Now, the thing about shedding expensive deposits and building the smaller liabilities is that while you're dropping a huge quantum, the smaller ones will grow in a relatively smaller pace, but serving more and more people, ultimately much more sustainable in the long term. All these initiatives impacted our total assets, as you can see, by a 10% drop, but now with a leaner and more efficient asset base to drive revenue growth while optimizing capital going forward. If you move to the next slide, this slide looks at the support we've provided to businesses during this period, particularly the compliance accommodations that we have responded to and the nature of the restructures. So you can see that in our book, the sectors that were affected the most in terms of businesses that we restructured facilities for in the real estate area, and we've supported a lot of commercial real estate. The agriculture area, which is an area which we play in significantly, particularly on the side of value addition, manufacturing, schools, which I'm sure you are aware of, leisure, hospitality, And I just wanted to point out those four, because if you think about, those are the sectors that are most transformative in the economy. And you can see the level of restructuring that they all enjoyed through the bank during the course of the year. So 22% was the contribution of real estate, 21% agriculture, 12% manufacturing, schools 10%, leisure and hotels 7%. Now, if you look at the maturity profile of these restructures, a large number of them, 40%, will be coming to term during the course of this month. In fact, today, at the end of today, 40% of the total facilities we have under restructuring, the restructures will be ending the compliance accommodations that had been given, and some 12% in June. But there are sectors that had been given an additional allowance to go a bit further up to September, particularly schools and hospitality. So that represents 26% of the restructured portfolio that we still have today. So every time those periods are coming to an end, work very closely with the customers to ensure that the relationship management is close and that the support that they need is available so that they come back into the normal repayment rhythm. We're able to support them getting back on their feet. And it will be different business to business, because different businesses were affected differently during the period of the pandemic and during the period they were under restructure. If we go to the next slide. So this slide looks at the composition of deposits again, as I have explained. You can see clearly that there has been a very deliberate and very consistent effort to improve the mix of our liabilities, gradually bringing down the composition of fixed deposits at one time, which was at 56% of the total liabilities of the bank, at 44%, down to 25% now. If you compare that just to last year we were at 29%. So you can see that consistent and continued improvement of the deposit mix of the bank. If you go to the next slide. So this slide looks at the key ratios for those very keen on the numbers. If you look just between 2020 and 2021, you can see that progress that has been made very clear. So our interest expense, interest income down from 32% to 30%, which is good. Cost to income ratio down by 13% from 63 to 50%. If we continue that trend downwards, that means that the company is spending less to run the operations relative to revenue being generated. If you look at non-interest income or to overheads, again from 37% to 52%. Of course, the return on equity has been impacted over the last 2 years because of the impact on the profitability, particularly because of the impairments. But with the improvements in the way the bank is run, that increased the efficiency. Once now that the economy is running well and the businesses will get back to their full rhythm, this should set us for a much, much better performance going forward. There are some key numbers there, very good for group. George, number of shares, no change there. Earnings per share, based on the improvement in performance in the coming years, we'll work to get that back up. But also looking at the core capital and capital adequacy in a good position there, where we have the regulatory minimum required for both. So I think, George, I would like to invite you now to take us through the equity markets update.
Thank you so much, Matthias. Just move to this slide, yeah. For just an update on the Uganda Securities Exchange, there are two indices that are used. There's the all-share index, which has the listed companies, locally listed companies, and also the cross-listed companies. And then we have the, we're comparing that to the dfcu share price performance. As you can see, for both the all-share price index and the local companies index, the both of these indices actually came down, and it's not indicated, it's not very clear here because of the size of the graph, but when you look at the all-share index, last year was down by 5.55% to date, and the local companies index was down by 12.75%. The dfcu share price has been trading between 630 last year, and it's now at 555, representing a drop of about 12%, but is basically in line with the other market indices. And the share price movement for the dfcu counter has been mostly a result of retail shareholders selling to pay for their daily expenses. And you find a 1,000 share trade can cause the price to move significantly. But that is basically it. The share price right now is 555. But we're talking to the analysts, it's still a very good investment if you have a chance to invest in dfcu limited shares. Thank you so much.
Thank you very much. We are playing musical chairs with George. So, so we'll touch just a little briefly on the strategy of the bank. So, if you go through a pandemic or a challenging time like the last 2 years and don't rethink one or two things about your business, you'll have missed an opportunity. So we've gone through a refresh of our strategy in that period, and refocused, and this is our new mission now, which is about transforming lives and businesses through innovative solutions and empowered people. It really emphasizes the focus of the bank on the impact on people, and acknowledges small businesses as the engine of growth that we will support, and increasing household incomes, because that's the most transformational way of transforming lives. And of course, empowering people. Those will be the people that work within the bank, but also the population which will constitute our customers. Empowerment comes through increased household incomes and wealth creation. And so that's our vision. It really connects on impact on people, which is extremely consistent with the legacy of the bank right from the time of the 1960s, when the institution was focused on social transformation through long-term development. And the mission is to grow shareholder value while playing a key role in transforming the economy and enhancing the well-being of our people. Again, speaks to value for partners, our shareholders, all the improvements we're making in the bank to be able to lay the foundation for long-term sustainability and value creation for our shareholders and our other partners, and thereby being able to be transformational from an impact on the economy through better improved livelihoods and better improvements in household incomes and growth and transformation of small businesses to create more employment, etc. And that sort of thing. That's crucial, especially today when we are looking at economic recovery post-pandemic, which is on the hearts and minds of everybody. So really, that's about our mission and vision going forward, which you will see a lot more encapsulated in the activities and actions we'll be taking and how we posture as a bank going forward. If we go to the next slide, which really gives a bit of a summary about, how does that tie into the key focus activities for us and the themes. There you see the customer coming back at the center of everything that we do. That's why we speak of customer obsessions. And winning positions will only be winning if they focus on what the customer is looking at. So essentially what we've done is gone back and re-looked at the various customer journeys and how those things come together, everything that the customer is looking for from the point they wake up and as they grow through the different stages, what sort of support they need and how we shall respond in that way. And so we've segmented our business into three: retail personal banking, retail business banking, and our corporate banking business, which is headed by Godfrey here. So long term, we'll be doing a lot more in those first two areas of retail personal banking and retail business banking to build the kind of capabilities and support that will enable us to be transformational to many more lives across the country. If you have a network of 56 branches like we do, and if you're in every corner of the country, your capacity to be impactful is dependent on how much you connect with the local business, the small business, and the everyday person, and that's something we want to do well. The other one is to really build on what we've done in the area of data and technology and being digitally driven. As you've seen already, just over 3/4 of the transactions of the bank now are done through digital. We would like to now get to the next level to be much more intuitive in how we use data to drive improvements and how we add additional layers of technology to improve turnaround, to improve business intelligence, and connect closer to the customer and be able to respond much quicker. The third area is building a high-performance culture, which ties into, again, the core of our people. The organization, the talent, and how we source and how we grow local talent, how we build, how we become more productive as an organization. But with increased technology and everything, the challenges and the risks associated, cyber, etc., as you know, are some of the greatest challenges today. And so as such, our focus on risk management now is really going to run much deeper and all across the bank. And then, of course, the key thing to make all of this happen, really execution. So be a very execution-focused institution over the next 3-4 years, and this should come through very clearly this year as we work to address the key issues, but also work to address the debt recovery and rehabilitation of businesses that you will have seen have impacted the course of last year. I'm not sure if that's the last slide. Do you have one more? Okay. Thank you very much for your kind attention. So we have our CFO in the house as well. We also have, in the introduction, we did not introduce the head of retail, Mr. Robert Wanok there. You may also stand so people can see you. Decided to have a whole table for himself. That's a strategy. Okay, thank you. Thank you, Jude.
Thank you, Matthias and George, for taking us through a deep dive into the numbers for 2021. So what we're going to do next really is just to take some questions. If you feel there's something where you need further clarity, I'm sure we were able to handle all the questions that we do. So we'll do that. It's 5 to 10 minutes, and then I'll advise you on what next. Okay, so now we are going into the Q&A. Feel free. If you don't want to speak, you can just write it down and on the notes, then I'll read the question for you. Yes, Ali. Ali from New Vision.
Yes, good morning. My name is Ali and I work with New Vision. Had a couple of questions, but along the way they kept on dropping. as Matthias was explaining the financials. But I have about 3 which have not been touched, and these, I think, go to George from the DFCU group perspective. During the last AGM, you told us about a case that was filed in London on where some shareholders of former Crane Bank took the group to court. Are there any developments in that line? Then I was seeing on the financials, yes, you made some modest profits, but there are no proposed dividends for shareholders. Why is that? And then this one goes, I think, to Matthias. DFCU Bank is the only, it's the only anchor subsidiary to the DFCU group. And you have this nice strategy going forward. We've seen other players in the market bring up more companies under the group, those that focus on fintech and all. Do we have a picture where we have more of these companies coming into DFCU? Okay, those are the 3. Let's pick it up from there. Thank you.
Thank you. I think we'll first do those so that we don't lose another say. I think most of them are probably addressed to George, I believe, even the last one, about the group and what else does the group do. So George, I think there are 3 questions. The first one was about the London case. Then the other one is about dividends. The third one is about what else does DFCU Limited do as a holding company. George, over to you.
Thank you so much for the questions. It's true, there is a case that is filed against DFCU in London, but I can't give any details because it's a case that is in court, and giving any further details who shall be. Yes, but it is a case that we are defending the group vigorously. So basically, it's still ongoing.
Did it have any material effect on the results?
No, it did not, yeah. The second question was on the question of dividends. The question of dividends is basically like 2-pronged because, as you rightly mentioned, the main trading company for the group is the bank. And as you're aware, over the last 2 years, the banks have been requested to get specific approval from the central bank. It's actually now a guideline that specific approval has to be received to be able to pay the dividends. So the group, until we get dividends from bank, there will be basically very little to pay out. So for this year, because of the challenges a few challenges that we've seen, especially in the area of impairments, the bank board wishes to keep the liquidity and to manage any headwinds that would come through. So the bank board recommended that there will be no payment of dividends to us. So we shall not be receiving dividends, hence we cannot pay out dividends this year. But that said, over the years, we've actually been paying very, very healthy dividend to our investors, and we shall continue doing that going forward. In terms of the group companies, right now the DFCU Limited has the bank as the anchor business, which is the main trading entity, but we also own the properties, including DFCU Towers. So we have properties, DFCU Towers, we have other properties on Mackinnon Road, in Mukono, in Bugolovi, in Namamve. We have a very state-of-the-art training facility in Namamve. which is open to hire from other companies. So basically, we have a property arm, and then we also have the Agricultural Development Center, which specializes in capacity building for farmer-based organizations. It's also, and then we have a property management company. But that notwithstanding, we are in the process of having a renewed strategy with a view of bringing in other businesses that will probably include insurance and fintechs and all that. But that's something that is at its initial stages and at a strategy level. Thank you so much.
Thank you, George. We'll take a set of 2-3 questions. So I don't know if you're loud enough, you can. Let me bring the mic.
Thank you. My name is Otuchu. I'm here for the Business Focus. You talked about the growth, the 3.1%, mainly coming out of trading. Could there be any other sectors? Apart from that, there are sectors that have genuinely done well the past year. One of them being manufacturing and agriculture. Could there be an effort being geared towards these sectors? The revenue from 2021 being talked about, I think 11.8 billion. Is this after taxes, or if it's not, what's the amount are we talking about in terms of taxes? Thank you.
I think these are also 3, so we'll take them, I believe, first.
So I'll comment on the first two, then maybe Kate, you can come in on the profit. Huh? So I think we're uniquely focused on agriculture, right? And as you've seen and even heard from George about how on the additional side in the group we support farmer-based organizations, etc. So growth, agriculture is our key growth area, without a doubt, and so is manufacturing. And I think that you will have seen even during that period, because even within manufacturing, there are different segments. People doing food, people doing different things. We continued to support through that period. Some of the manufacturing businesses did have some restructures as well, but we continue to provide support to those two sectors. And we will continue to, because these are key focus sectors for the bank. So Kate, maybe you can comment on the financials. I think net profit, you talked about revenue, but I think you wanted to come closer to profitability, right? After tax, yeah.
Thank you. Jude, if you could just put back the slide, please.
Okay, just a second. Let's get the slides back up. Slide, Martin, I think you can, okay.
So in terms of the statement of comprehensive income or the profit and loss, the growth that Matthias mentioned about, which is the growth in net income, the net income does not include the taxes yet, so it's only the line on income tax. That's when the taxes come in to give us the profit after tax for the group at 9.3, with the tax charge for the year at 3.4 billion. Thank you.
I believe that, I think, clarifies that question. So we'll take another set of 3. Okay. Yes.
My name is Catherine. Mine is actually on the impairment, losses on their loans. How much of that composition actually has the portfolio that Crane Bank had? Then the other thing I think is the business, the nature of clients that DFCU has. In terms of contribution to revenue, who are the main focus areas? And let me say, for those that are not contributing well, because I think I saw retail, I saw business, I don't remember the third one, but what is the bank doing intentionally to grow their target area that may not be contributing as much? Thank you.
Okay, we can take this.
Actually, so I'll start with the second one, and Kate, you can have the one on impairment. You see, Kate is getting all the exciting ones. On the second one about businesses, right? Actually, our growth last year is from our retail business. The key growth is from our retail business. And that is the area of focus for growth. If you look at Uganda, and you look at the nature of our business in 56 locations, right, across the country. If you try to understand, the nature of businesses across all to local businesses that had the capacity to scale up and be transformational in the economy. As we moved into banking, that evolved into our corporate banking business. So our corporate banking business is typically large local corporates, right, that have started as small businesses and have scaled. And because we have the capacity and the desire to see them grow, we support them, to be able to go along that path. So we'll continue to do that in a very selected way. But we've also determined that we will pay special focus to nurturing smaller businesses so they can scale up and grow. So the focus is really a retail focus, both for business and personal. But in there, segmenting very clearly and having very clear stratas along the way to see that we have the right solutions for the different segments. So it's really a universal bank, if you think about it, which has determined to really drive value out of the retail business that we have.
Thank you. Thanks, Matthias. Going on to the provisions, maybe I'll just give a second on the background. So there were two types of loans or two types of customers that we took on from the 2017 transaction. So we took on some customers who are not performing already, but because of their accounting standards had to be fair valued and an amount recognized on the balance sheet. Those are the ones that really are traceable and relating to Crane Bank. So these are really relationships where we found many of the customers multi-banked, consolidated the relationships. So back to your question, to the customers that we took on in 2017. If you look at just the two lines below operating expenses, impairment losses on loans, that is normal business, normal ongoing business, and fair value loss on the financial asset is the 30. Now, how the fair value works is for every year that a customer does not pay or postpones payment, you have a loss in the present value, which is the amount that we recognize in the P&L. It does not mean that this customer will not pay, and it does not mean that but the present value of money has actually come down. So that's the separation between the two. The first one, which is the 148, is normal business or our normal ongoing customers, and the second one is the one from Crane. So in terms of the ongoing customers, we had customers, who were affected by COVID. So that delay in paying, they're supposed to pay you this year and they roll over and don't pay this year, but hope to pay next year, that is the impairment that we take in. Thank you.
Okay, thank you. Any other? Okay, gentleman from Business Focus, Lawrence.
It's maybe too early, but maybe just if you may. 2021 saw a number of businesses under lock and key, of course for obvious reasons. But almost now, I think, about 2 months, we've realized full reopening of the economy. Just if you may, what do you project? What are the projections? Thank you.
That's a nice straight question for a nice straight answer. So the outlook for 2022 is positive. It's good. And you really have to look at, these things are about sentiments also, right? With the economy fully open, all ecosystems open, schools, etc. The outlook is positive, right? But of course, you're beginning to see inflation creeping up. That will have an impact. But from a point of view of dfcu, we expect 2022 to be a good year, better than 2021. 2020, we were in the middle of the pandemic, 2021 as well. Now the economy is reopened. The world is open for business. The geopolitical challenges in Europe, the impact of those, it's too early to tell generally. But if you think about the FID and the positive message coming out of that level of investment that will come to Uganda. Ugandans are very resilient people. Let me just say that Ugandans are very resilient. And if you look at small businesses, for instance, and the ability to cope in challenging times, yes, we might provide, moratoriums and restructures during that time, but the capacity to bounce back once they're able to trade and to work is something positive about the spirit of this country. So we expect 2022 to be positive. Coming out of the impact of the previous years, coming into recovery, but of course returning to normal in every sense. I expect that will be 2023 and beyond. It will also depend on what space you're playing in and how much you were impacted in the previous 2 years. Thank you.
Okay, sorry, you maybe introduce yourself as you put forward your question. Thank you.
Good morning. Good morning. My name is Abraham Bakunda. I just have a follow-on question on the impairments. What sectors composed that impairment?
Okay, Kate, would you like to comment? We'll take them together.
Okay, is there another?
Yes,
question?
just one observation.
Okay.
From the financials we've seen so far, net interest income seems to be, seems to make banks more money now compared to the other side where we see banks need to lend more. Is this a trend that you are going to see in the next, let me say, 2 to 3 years, where banks focus more on making money from non-interest income sources? Thank you.
Okay, so maybe I'll speak a little bit on that, then I'll ask Kate to come in a bit more on that and other things from the first question on impairment. I think that banks need to be versatile, right? And they have an array of services. And so some of those services are fee-based. And the lending typically is interest. But banking is part of your lifestyle, right? And there are many things that a bank will do for you to ease your life, right, and have them fee-based, which may not necessarily be lending to you. So it's leveraging your capacity as a lender to do a lot more and play more in the life of your customers, right? And be more transformative. And then you have to be rewarded for that. And so that speaks to the need to, balance out your sources of revenue, but also it speaks to how sustainable you will be in the long term. So let me leave that there, and Kate, you can come in.
Thank you. In terms of the sectors that comprise most of the impairment, we had the sectors that were affected by the pandemic and a bit of the delayed payments. So sectors like construction was very heavy. Construction, real estate, we had a bit of trade because there are many customers where they had shipped out money, some bit of their stock did not come on time. So we had trade, we had construction, we had real estate, and some part of tourism. Those were the main ones. Thank you.
Okay, thank you very much. We will stop here as far as the Q&A is concerned. But if you have anything, we can handle that on the sideline. If you need any clarity on any particular line in the financial, handle that on the sideline. So we've now come to the end of this session. Thank you all for having took aside your time to come through. We believe we have given good clarity to the numbers, and we look forward to good reporting on the numbers, or balanced reporting. I think that's a better word. So, but if you need any clarity, really, we're open to do that. Our CEO will be around for just another 5-10 minutes. If there's anything really that's burning that you need clarity on, especially our friends from the Luganda-speaking stations. I know you normally want some versions in the local language. We shall take that on the side. So once again, thank you very much and have a good afternoon.